Well, greetings, my beloved clients and friends. I'm coming to you on Labor Day, enduring the scorching heat, to give you guys an update. So last week, basically the last week of August, was a little bit rough. I think we gave back most of our gains from the month of August in the last week. And so what happened was, about a week and a half ago, Fed Chair Powell made a statement from Jackson Hole, Wyoming, and he came out swinging. And he said, in no uncertain terms, that he was going to fight inflation and he was going to win, and no matter what it took. And if that meant bringing some pain, he was okay with that. If that meant the unemployment number would rise a little bit, he was okay with that. If it affected the markets, he was okay with that. His number one and really only priority was stopping inflation. And so the market wasn't crazy about that. And the market's been in a very accommodative Fed for the last 13 years, since the last 14 years, since the global financial crisis of 2008. And so I think my take on it is that he asserted his authority like a parent, like a father. And he said, you know what, there's going to be order in this house and discipline, and I'm going to do what I have to maintain that. And the market, like a spoiled child, went in the corner, held their breath, but they realized that their dad is in control. And so he didn't say he was going to raise rates. What he said is, I'm going to do what I have to, and if that includes raising rates, I will. And like a father that doesn't have control over his kids, he has to spank them a lot because they're always out of control. But a father that does have good control, he hardly ever, if ever, has to spank them, because they just, they fall in line. And so I think the market was reacting in a way like a spoiled kid, like, oh, I'm not going to get my way anymore. But long term, he did the right thing. And it's funny because they were complaining prior to that Powell's not coming down strong enough. Well, guess what? They woke up dad, you know what I mean? And so I think what he did was good. And I don't think he's gonna have to raise rates as much once he's in control. Okay, because the expectation of long-term inflation is the thing that creates short-term inflation. And if they realize, oh no, there's not going to be long-term inflation, dad already said, you know what I mean? Then that changes things. And if you look at just look around, oil prices are not up. Oil's down in the 80s, and this is Labor Day weekend, and oil's down in the 80s. Crypto is not up. Gas is down. For being a Labor Day weekend, gas is not spiked up. Commodities have stabilized. The supply chain imbalances are working themselves out. Housing has really cooled off. New car sales really cooled off. So as far as inflation, I think the worst is past. And he's still going to continue to raise rates a little bit more, but I don't think much more than has been expected. So the other thing is that it was the last week of summer, effectively. It was the last week before the Labor Day weekend, the long weekend, which is traditionally and historically when a lot of Wall Street goes on summer vacation. And so historically, the last week of August has been a week of of light trading volume. And this year was no exception. So there was a big down move on very light trading, okay? So it doesn't really signify much because the big firms don't want to do a lot of buying. Their main decision makers are probably not there. And they know the market's going to be volatile, so there's not a ton of buying. It's probably safer just to be in cash and, you know, whatever money they need to raise. So there's a tendency for there to be light volume and a downward pressure. If you have to sell, sell. But if you have to buy, wait. Kind of that's the approach towards the end of August. And so it tends to create a volatile market with pressure to the downside. So what we saw last week doesn't surprise me, doesn't worry me. Now I get paid on the month-end balances, so it wasn't something I was looking forward to, but it's like, okay, I gotta take one for the team, and I'm not gonna panic and sell stuff. So that's how I see the events of last week. And you know, I don't see inflation getting worse. I think we've seen the peak. Now, geopolitical risk could throw a wrench in that. If oil spikes in the winter, that changes the whole story. But aside from that, I think the fact that Powell took a strong stance, in a way, I mean, it's not fun, but in a way he assured the market that he was in control. And I think when the traders come back next week, they're going to see that there are some buying opportunities, because some really good companies are trading at very attractive valuations right now. And we had 5 on our list, and 3 of them were really close or almost at our buying price, and we were very conservative on that buy price. As a matter of fact, we bought one, so I'll go ahead and announce it on the call today. We bought Salesforce, symbol CRM. Founder and co-CEO is Mark Benioff. It was founded in 1999, and Mark Benioff had been a star at Oracle before he went off on his own. And I've talked before about some of the tenets of our company. One of them is software eats the world. And one of the areas that we like is called SaaS, software as a service. Well, Mark Benioff invented SaaS. He's the father of SaaS. And he said, when he started his company, this is the end of software, because prior to his company, you'd buy your software, you know, you'd buy that Microsoft Outlook or whatever, you know, every year, however, Excel, you know, you'd buy it. And he said, no, we're going to put that software in the cloud, and we're going to rent it to you on a monthly basis. That's that subscription-based software as a service. And that's the space that he created and dominates. And so they're a Dow component. They're a component of the Dow 30. They're a $150 billion company. That's their market capitalization, which is down from $300 billion. So they're a little over 50% off their highs. Right now, when we bought them, and right now you can say, they are trading at 5.3 times sales, which is the lowest multiple of sales that they've been trading at since mid-2009, since near the bottom of the global financial crisis. So it has not been as cheap as it was this week since 2009, in 13 years. So I saw it as a tremendous opportunity to buy a great company, a market leader with a great, I love the leader, Mark Benioff, awesome guy, CEO of the year many times, and just a visionary. And so what they do is they provide enterprise software. They provide software to most of the Fortune 500 companies. And their symbol CRM means client relation management. So they would dominate the space. And so what they have done is they dominated that space, and it's kind of like the Procter Gamble model of if we sell the leading shampoo on the aisle, let's buy what's ever next to us on the aisle. We'll buy the shampoo, we'll buy the hand soap, we'll buy the conditioner, we'll buy the toothpaste and the mouthwash, and we'll just, from the profits of the previous ones, we'll roll up and buy the other ones. And it makes it convenient for the grocer. You just buy from one place, and you have one sales guy that calls on you, and you could just keep going all the way down the aisle for decades. And so, because they have the dominant position. And so they've, from the last time they were at 5.3 times sales in 2008, stock is up 22% annually. That means the revenue growth is 22% annually over that period of time. And so that's really good growth. And I think they have an avenue to continue to grow at a above average rate as they capture more wallet from each of these companies that they own. And all they got to do is see, like, you know, who else is selling you software and doing good. We'll just buy them because they have the cash flow to do it, right? And so some of the things I love about software as a service in general, and Salesforce in particular, is they don't deliver a physical product. So they don't have to make it anywhere. They don't have to inventory it and then decide, well, how much should we make? And because, you know, if we sell too much, then we have extra. If we sell too much, not enough. And if we make too much, we have extra. If we don't make enough, we have a shortage. And there's a coyote on the path in front of me. Let's see if you can see it in the background there. I don't know if you see it. Anyway, so I'm letting him pass. But that is software as a service. They don't have any of those problems. So if there's a chip shortage, right, or they don't need to invest in more factories to grow, more warehouses to grow, because the thing they sell and they send to you is a virtual thing that, you know, if 5 people decide to buy it or 50 million people decide to buy it, it's the same thing. They just download it, right? I think it's just a superior product to any product that has to be manufactured and warehoused and shipped and delivered. So what if there's a problem at Long Beach, or there's a tanker stuck in the Suez Canal? That does not affect Salesforce. Okay, minimum wage goes up on you know, factory work or whatever, like that's not a problem to Salesforce. So that's one reason I like software as a service, and then it's a recurring monthly fee that you collect like clockwork every month. You know, it's that monthly fee that you collect. So the new client just adds to the revenue base. They don't have to sell a new product every month. They got that recurring fee that hits, and the growth is just on new business. And so when you have a company like that, looking at the balance, at the financial statements is a little bit different. Because if you have a typical company that makes stuff, and so you're the shareholder, you're the owner of the company, you want them to send you, you want to get the profits to you. And how do they get the profits to you? Well, one way is they could pay a dividend. But a dividend tax-wise is very inefficient, because first the company has to declare profits, pay tax on those profits, and then send you your dividend. And then when you receive the dividend, you pay tax on the dividend. So it's effectively taxed twice, by the corporation and by the individual receiving it. So it's a very inefficient, although popular, way to pay shareholders of a company. The second way is through earnings. And so if you don't use your earnings to pay dividends, what else can you do that's to the benefit of the shareholder? Well, you could pay down debt, which I wouldn't recommend Salesforce to do because they're a Dow component. They probably borrow at 3% and the company is growing at 20%, right? So would you rather have them take that money to pay off a 3% debt or take that money to invest in a company growing at 20%? Would you rather get 20% on your money or 3? So you don't want them paying down debt. You want them using debt if they could borrow at 3 and invest at 20. Okay, so you don't want them paying down debt. The other way is they could buy back stock, buy off their partners so that the remaining portion is bigger. And this is one of the things that I didn't like too much about Salesforce. They have been diluting their stock over the last decade plus, over the last 15 years plus, meaning they're issuing more shares, diluting my interest by bringing in more partners, right? Well, in their most recent quarter, they just announced their first ever stock buyback program, which I really liked because they were getting pressure from investors like, you guys keep diluting us. And so they addressed it, not only saying we're going to stop diluting, but we're going to start buying back. And I think that was the smart thing to do and gave me a lot of comfort. And I believe, why would they do it now? Because probably they also view the current price as an attractive price to buy that stock. Okay, so I really like that sign and it addressed one of my concerns. So the other way a company could bring value to its shareholders is to invest in the company, right? Like if you own McDonald's stock and they open up 150 more McDonald's, well, that's good for you. That's more revenue coming in for you. And they do it with their own money, right? Without asking you for money. But when they do that, when a brick and mortar, when a company that makes stuff does that, the factory or the equipment or whatever capital good they invest in, that purchase is called CapEx, capital expenditure, and it must be amortized over the useful life of whatever they bought or built. If it was a factory, if it was a piece of equipment, they have to amortize that. And that happens after they pay tax. So they get the expense write-off over time, not all at once. One of the beauties of a software service company is the things that they would do that would be normally considered a capital expense, something to build the company, is a thing that they could write off in that year for the full amount. And the 3 things are R&D, research and development, right? So research and development, advertising, and hiring of talent. Okay, and all those 3 things you could write off in the current year. Okay, so if you look at Salesforce's income statement, their gross margins are like 77%. That means the cost of their goods is very small and almost all of it is profit. And what do they do with that 77% of the sales that they get to keep? They spend it on 2 things. SGA, selling general and administrative expenses, and R&D, research and development. So almost 20% of their revenue goes to R&D. It goes to grow their company next year, right? That's how come for the last 20 years, they've been growing at north of 20% a year because they keep investing back in the company with pre-tax dollars. And if I'm the shareholder, that's what I want them to do. I don't want them to pay me a dividend. I don't want them to pay down their debt, their 3% debt. And unless their stock's really cheap, I don't want them to buy their stock. But if it is cheap and they could, then I do want them to buy their stock. And then I also want them to grow the business. And if they have that Procter & Gamble model that, hey, all I got to do is buy that other software company that's currently, selling to my client, I'm going to bring them under the fold and I'm going to take those profits. Okay, so especially if it's accretive, and it usually is because there's so many synergies and economies to bring those 2 things under the same roof. So they have a model that they can continue to grow for a long time. They have a great client base. They have recurring fee revenue, and it seems like the stock is cheap right now, and they're able to grow the business on a pre-tax basis. So I don't look at price to earnings because they don't show earnings. They don't have to pay tax. So if one company has to pay tax and another company doesn't, who has the advantage? The one that doesn't have to pay tax. Because, like if you have a company and you go to your accountant and it's December and he says, wow, you made a lot of money, go out and buy something real quick to bring your profits down so you don't have to pay so much tax. That's what they do, right? They're like, man, we had a ton of profits. Let's go buy something. Let's spend it on R&D, or let's buy another software company that complements what we do, and they could broaden the suite that we could offer to our Fortune 500 clients. So yeah, love the company. I've loved it for a long time. It finally got to the price that I wanted, and if I did not buy it in 2009, there would not have been another opportunity to buy it as cheap as I bought it last week. So is it the absolute bottom that I bought it at? I don't know, but it's close enough for a great enough company that I think over time that position is going to do very good for us. Okay, so I hope you guys have a great Labor Day weekend, and any questions, feel free to reach out to us at the office or give me a call. Have a great weekend.